Wall Street, strategists see AI and economic data replacing tariffs and the tax bill as the big focus for investors going forward. Barclays strategists expecting more gains for stocks with AI driving earnings. Joining me now, we've got Thomas Hayes, who is the Great Hill Capital Chairman and Managing Member. Thomas, great to have you here on set with us today.
Great to be with you, Brad.
Absolutely. I had to try and squeeze your question in with our previous guest, Dan Ives, but I got to know as well, since you are also very closely tracking this space in AI, how are you looking at AI and how it's playing into the broader market rally right now?
Yeah, look, I think Dan is spot on. The demand exceeds supply by 10 to 1, and that's the issue with Nvidia right now. Their business model depends on the kindness of strangers. So Taiwan Semiconductor has limited their revenue growth each quarter to $4 billion because that's all they can fulfill. So for the next phase of Nvidia's growth, you need to see those fabs get finished by Taiwan Semiconductor to increase capacity. And I think the dark horse that no one's paying attention to, you've seen a stealth rally in Intel 45 miles an hour in the slow lane, 10% plus this week, and I think part of that is Lip-Bu-Tan is cutting staff. I think the other part is they're the only game in town with fabs at the 10-yard line ready to spike the football and the touchdown. There are chips being tested on their fabs, and I think if they can be a part of that supply solution to Nvidia and others, that could be kind of a dark horse. So while you see maybe Nvidia double, if Intel gets it right, it could be meaningful.
You know, that also raises a similar question that we had brought up in our previous conversation with regard to how many of those chips will be able to be shipped to other parts of the world if so much of the money that's helped Intel get to this point has really been prioritized at bringing up and scaling up production here in the US.
Yeah, well, I think once they get that production set, I think the sky's the limit as far as global demand. And I don't think they need to be best in class. I think there's going to be so much unlimited demand that anyone that can produce, even second tier.
That's a weird call to say, hey, just be mediocre in class.
By the way, that's my base case with Intel, is they are the leader of mediocre chips. And by the way, as they bring this capacity online with Lip-Bu-Tan, he did unbelievable things at Cadence Designs. That was a multi-bagger. No one's better. He's going to fix it. They're going to be part of the solution. It's going to help NVIDIA. It's going to help Intel, et cetera. And it's going to help boring, normal businesses that implement AI, which Dan alluded to, which is going to be huge, which no one's looking at right now. Right now, you think AI, you think Mag 7, you think Palantir, you think NVIDIA, but the big beneficiaries are also going to be real businesses.
What needs to continue to take place or transpire within business spending towards AI to really continue to allow the AI trade to keep its foothold on this market and be the kind of core barometer of the investment psyche, if you will?
Yeah, it's really interesting because you see the Mag 7, and there's like a good news is they're benefiting from the AI trade. The bad news is their earnings growth is collapsing because they are doing all this CapEx. So Q1 of this year, earnings growth in Mag 7 was 27%. Q1 of next year, 2026, earnings growth is going to be 10.2, but the multiples have not really compressed. No. Then you take the unmagnificent 493, all the boring companies that are going to benefit from these technologies in terms of implementation, their earnings growth was negative. It's going to be 10.3%, and the multiple is meaningfully lower. So I think there's a lot of unexpected AI opportunities. If you take Brad Jacobs, for instance, he does all these roll-ups. QXO, where he buys boring businesses, building supply companies, et cetera, and he goes in and he doubles EBITDA with technology. He's a huge implementer of these technologies in boring businesses. GXO Logistics, they're one of the first businesses using humanoid robots to help move the stuff in the different distribution centers and warehouses. So it's pretty wild.
I've got Brad Jacobs' book on my desk. Thank you for sending that, Brad, by the way, from one Brad to another. Just lastly on this topic here, because we're going to discuss a range of topics throughout the morning here, but as you think through the leaders of the tech rally right now versus the rotation that we could see, names that have been underappreciated, where are those parts of that trade?
Yeah, I think, the market's going to continue to push higher for the next 4 weeks. Why? Partially because of global liquidity is back at an all-time high, partially because earnings expectations are really low. They've taken them down from 9.3% to 4.9%. So that's going to drive the bus. Mag 7 is kind of back up to the top of the range despite earnings growth deceleration. So I do think as you kind of stabilize after we make those new highs and everyone gets euphoric and tech's got to push it up because of the weight in the indices, I think that second half of the year where you're going to benefit is the unmagnificent 493. But it's interesting, I'm looking at today, small caps are outperforming the NASDAQ. So Russell 2000 outperforming the NASDAQ, outperforming the Dow Jones, outperforming the S&P 500. That is the small cap index is the most shorted in history right now. And these are the type of companies that benefit from these technologies. And I think you're going to see the back half a big surprise in the 493 in small caps in companies that will be beneficiaries of the great things that the Nvidias of the world are providing.
Now for today's Power Players segment, time is running out for senators to reach a deal on President Trump's tax plan. The president wants the big, beautiful bill on his desk before July 4th. As the deadline closes in, it's still not clear to markets what the bill's economic impact will be. The White House Council of Economic Advisors estimates growth from the new tax plan could slash up to $2.3 trillion from the deficit, but the Congressional Budget Office found the mega bill would add $2.4 trillion to the deficit over the next decade. Joining me now to explain that disparity is Stephen Myron, chair of the White House Council of Economic Advisors. Stephen, good to see you here. Let's start there. What do you attribute that huge disparity between your projections and the CBO's?
Good morning, and thanks for having me. Look, the issues with the Congressional Budget Office's score is that they're not designed to be a holistic view of the deficit. They're designed to play into very specific rules for passing legislation through what's called the reconciliation process in Congress, that you only need a simple majority to pass rules instead of the filibuster-proof supermajority of 60 votes, right? That's a really sort of highly specialized and Byzantine process, and it's just a mistake to extrapolate from the CBO score to think that you're understanding what's going to happen to the deficit overall. There's a number of things that are not included in that score that will reduce the deficit. Let me go through some of them for you. First, better economic growth. The One Big Beautiful Bill contains numerous tax incentives for better economic growth. There's full expensing on investment, full expensing on equipment investment, on new factories, on R&D. There's things like no taxes on tips and overtime and Social Security. And these are targeted at segments of the population that are very responsive to incentives to work more. And these will get economic growth booming, right? In addition to keeping tax rates low and preserving the president's historic 2017 tax cuts. This economic growth creates more revenue because if there's more income, then there's more taxes that get paid into the government, and that brings the deficit down. But there's lots of other stuff that the CBO doesn't include also, things like tariff revenue, things like cuts from discretionary spending administratively, things like lower interest burdens because we're borrowing less because of these other things. And all of these combine to materially bring down deficits. We calculate that when you add all these things up, better economic growth leading to higher revenues, tariff revenue pouring in, less discretionary spending because of administrative cuts to waste, fraud, and abuse, and lower interest expenses, we calculate that when you add all these things up together, you get about $8.5 to $11 trillion of deficit reduction over the 10-year budget window.
Stephen, let me push back, because within this report, I believe you're projecting 4.9% economic growth. However, the tax rates are going to likely stay the same in this plan versus 2017. What do you say to those that are saying you're being too optimistic on the output potential of the economy?
Yeah, so that's actually not the growth projection. So that number, 4.6 to 4.9% GDP growth over a 4-year period relative to letting the tax cuts expire, mean that GDP will be about almost 5% higher at the end of 4 years than before. Now that works out to a point to a point and a quarter a year, right, of better GDP growth from this, which brings GDP growth into the high 2s range. As a result of the One Big Beautiful Bill and the other policies we've got going on. So it's not a correct reading of the paper to think that we're claiming there's going to be 5% GDP growth. Okay,
fair enough. Now, you mentioned tariffs, and I want to dig into that a little bit, because you have tariff revenue reducing the deficit by close to $3 trillion. Now, in the report, those estimates were as of a June 7th memo from the Office of Management and Budget. Now, with these tariff negotiations still going on, should investors still expect tariffs are a key plank of the U.S. economy over the next decade?
Yeah, so the Congressional Budget Office finally did something on tariffs where they said that, and it's not included in the score for the bill because tariffs aren't part of the bill, right? But the CBO finally did something on tariffs, and they found that tariffs would bring in about $2.8 trillion over a 10-year window. Plus, if you reduce interest expenses on top of that, it comes to about $3 trillion, right? Which more than pays for their static score of the bill. Now, Those numbers are very similar to our internal estimates. Our internal estimates are maybe a hair higher than that, but not materially enough that it's worth splitting hairs over. You do make the point that negotiations are well underway and that countries are lining up to make concessions to the president so that he can secure trade deals, and that is very true. Now, while I do expect that many deals many frameworks will be announced in the next couple of weeks, running up to the July 9th deadline, and that we are in the process of making very good deals, I don't know that I think the tariff rates are going to go in aggregate materially below where they are now. And so, while I can imagine a few countries maybe making such aggressive concessions they convince the president to lower tariffs below 10%, I don't see that being necessarily the case across all countries. And I'm sure there are other countries that are just going to be stubborn and decide no, and then they'll have the Liberation Day tariff snap back up on them. So some tariff rates may go down a little bit, it's possible, but other tariff rates will go up a bit. And so in aggregate, I don't know that the overall level will change that much. Moreover, if tariff rates are coming down, it's because other countries are making concessions to open their markets to American products in order to achieve those lower tariff rates. Right? The president is using tariffs to negotiate reductions in non-tariff barriers so that American goods can enter foreign markets and that we have reciprocal and fair trade. If American goods are entering foreign markets, then we're selling more. There's more income. There's more corporate income, there's more personal income, and these both get taxed in the same way all other corporate and personal income do get taxed. And so revenue still goes up either way. You just substitute tariff revenue into normal tax revenue. Sure. But in either case, money pours into the federal government.
Stephen, you're making some good points here. Let me just follow up here with this one. Now, Treasury Secretary Scott Bessent said earlier this month it was, quote, highly likely that the president will push back the July 9th tariff date. Is that still the case?
So my expectation, and to be clear, I'm not a trade negotiator. I'm not in the nuts and bolts and the weeds of all these negotiations. But my expectation would be that for countries that are negotiating in good faith and making progress, that rolling back the deadline makes sense. I mean, you don't blow up a deal that's in process and making really good, good faith, sincere, authentic progress by dropping a tariff bomb in it. You do that when you're at an impasse and you're not making any progress. And the president has shown successfully time and again that that's how things work. So when talks with the EU weren't going anywhere, the president threatened 50% tariffs. That immediately resolved the impasse, and then talks resumed and started making really good progress. And the president said, okay, no 50% tariffs, we'll stay at 10% because we think we're making progress towards a deal. And that was very, very encouraging. And so my expectation would be that if talks are making authentic, sincere, good faith progress and that they're really moving forward, then I don't see why rates would snap back higher aggressively. If they're not, then I could imagine they do snap back higher aggressively.
Let's take a look at the AI trade. It's booming right now. Nvidia shares hitting an all-time high in the stock on an upward swing since its strong earnings report in May, seeing a big turnaround from earlier this year. Joining me now, we've got Dan Ives, Wedbush Securities Managing Director and Global Head of Technology Research. Dan, great to have you on the program with us. We saw strong third quarter results from Micron, boosted by AI demand. So how does this factor into the broader AI trade and add just another thought in the frame of mind for some of the Nvidia investors out there as well?
I mean, there's one chip fueling the AI revolution, and that's Nvidia. And I think investors are starting to recognize we haven't even seen the biggest growth driver yet of AI, not just on enterprise and the use cases, but on the consumer side and ultimately autonomous and robotics. And in my view, it's not just $4 trillion. I mean, we're going to be looking at a $5 trillion market cap in Nvidia.
And so at what point, what's the kind of modeling and the time frame that you're kind of anticipating that could come to fruition?
Street's still underestimating growth longer term, I think by 15 to 20%. That could be conservative. I think when you actually see the dynamics playing out today, remember, they took China basically out of their forecast. And if you have any trade deal, a big chip on the table is Nvidia, and I believe they're not going to hand that business on a silver platter to Huawei. So I think right now investors are starting to recognize the growth opportunities for Nvidia, and we've talked about it, demand to supply 10 to 1.
And so, as we're thinking about that, and you mentioned China, one of the major factors within any type of trade deal is going to be IP, that intellectual property. What is the likelihood that we see an outcome on the intellectual property front that is favorable for Nvidia, and what does that do in terms of unlocking some of that addressable market?
I think probably less for Nvidia from an IP perspective. I think the bigger issue from an IP, especially with a lot of the software players, that's been the big issue when it comes to China. But look, there's a give and take here. And the reality is that Jensen wants that business back. He's talked about it. And, when you think about it, 8 billion a quarter, but eventually that could be 10, 12 million a quarter. But China, they know that there's only one chip in the world fueling AI revolution. That's the godfather of AI, Jensen, Nvidia.
We've heard some really strong calls for even $6 trillion market caps for Nvidia here. What is, you think, the critical kind of checklist in order for us to get to that point?
I think checklist is, and just take all the geopolitical out for a second, but I think first it's the use cases that are now exploding. And we're seeing that in the hyperscale and Microsoft, of course, names like Palantir, which continues to be one of our top names. Then it's the consumer piece, everything Zuckerberg and Meta's doing, what we're seeing with Alphabet and others, because that's a whole nother leg to the stool in terms of the consumer side. And then the holy grail, autonomous, robotics, humanoids, that's not even being factored in here today.
And so you mentioned a few of the other themes that I wanted to get to as well here. You, of course, are tracking Palantir and another name that's seen new record highs. What do you think is really contributing to the mindset around the trading and the thesis for Palantir right now?
Look, I mean, they hate it at 20, despise it at 70, call it expensive at 100, right? I mean, now the bear is 145 because, as we always say, they can't find AI in the spreadsheets when they're in hibernation mode. Palantir, we view as $1 trillion market cap next 2 or 3 years. There's no company from a software perspective that has what they have. And I think now, as they go further and further after the enterprise, as sovereigns go down the AI path, this is just the beginning of what's going to be a golden age of Palantir. And I think, look, is it expensive today? Of course. But if you look out 2, 3, 4 years, I mean, we're going to be talking about one of the most transformational companies in the world.
And so within that transformation, they also might need to see a transformation of their own that you started to allude to there. And I just want to hit on that because they often talk about how much their contracts are intertwined with government entities. To what extent do you think we see that start to accelerate towards large enterprises with large recurring run rates as well?
Yeah, and look, that's been a huge part of the valuation uplift that we've seen over the last 18, 24 months, because now more and more they're an enterprise play. Government never really get a multiple, just given the nature of contracts. Now in the enterprise, there's no AI bake-off that Palantir is not front and center. Either they won or they're going to be at top of the list. And I think that's really been the difference maker is on the enterprise, and investors recognizing they're one of the biggest disruptive technology companies in the world, along with Nvidia, along with Tesla, and I think this is just the beginning of that next chapter.
While we have you here as well, we were taking a look at one of your other notes, specifically around Microsoft right now, and it's amazingly and kind of befuddling sometimes how it's not the sexiest stock out there, yet it continues to show how it is a powerhouse that can chug through any environment here. So as we're thinking about how Microsoft can differentiate itself within an era where they've already been early investors in generative AI and trying to figure out where they need to further entrench some of their market positioning there, what do you think is the next critical leg that Microsoft needs to implement in order to see that realized within their results?
Yeah, great question. I think it's, look, the commercial cloud business, Azure, the AI stack. I mean, this is right in their backyard. Look, if you, of course, Amazon, Google, they're going to continue to have success, but no one understands it better than Nadella. And I think that is something the street is still underestimating. We talk about 25 billion incremental growth into next year. The street's not even factoring in. And that's why I always say, like, This is a name, if you look at it, traditional glasses of an old Microsoft, that's not just the way to think about it. You have to, when you look at names like Microsoft, IBM, Oracle, these are transformations that are happening today in terms of the install base and the AI stack. And that's why these stocks are doing what they're doing.
Within that, we also know that up against Google and their own cloud product, and then additionally against Amazon and AWS, what type of market share, not shifting, but stealing of that market share are you seeing in terms of the jousting between these three major players on that cloud front?
Yeah, I mean, to put it, look, if you think Amazon, let's say 6 or 7 of every 10 deals, right? They essentially, from a cloud perspective, because they were first mover, basically owned. And now, as you think about more and more customers move into AI, move into the stack, think about that 7 of 10, it's kind of reversed. I think Microsoft, 7 of every 10 cloud, from a hyperscale perspective, they're winning. That's the difference. It's kind of been reversed. Jassy is clearly going after, it's going to have success. Google and Curry and what they're doing as well. But Brett, this is Redmond's backyard in terms of the enterprise. And I think that is why they're so successful, because these are install-based customers and they have the full stack from 365 to Azure to Copilot.
Dan, just lastly while we have you, and I got to be brief, just going to throw it out there. Cybersecurity in the age of geopolitical conflict, how much more do you think that gets the mind of investors, considering what we've watched play out over the last several weeks here? And, oh yeah, by the way, we still have a deadline that's looming on the tariff policy front as well.
Just another talent for CyberArk, Palo, CrowdStrike, Zscaler. Even when you talk about retaliatory, we saw that with Iran, retaliatory cyber toward U.S. Israel, it benefits cybersecurity companies. That's why it's going to continue to be, I think, probably the biggest outperformer within broader tech. And that's why we also have a bunch of cybersecurity in our IVES AI 30, because that's the second, third derivative of AI.
And then, Dan, just lastly here, because, and I do want to get to our next guest, who is sitting on set with me. And one of the questions that he slid me, Thomas Hayes, who I'm sure you know well as well, he slid me a question saying there's 10-to-1 demand to supply for Nvidia on the chips front. Do we need more progress on fabrication, especially considering TSMC and Intel right now, to help fulfill some of that demand?
That's a great, and he's great, and that's a great question. It's true. I mean, because ultimately you need more supply, you need more production. The problem is, like, look, Intel, I mean, they're stuck in that right lane, 45 miles an hour in a minivan, right? Like, so that's part of the problem. But it's a demand supply issue. Demand's not the problem, it's supply.
All right. Dan, thank you so much for taking the time here with us just after the opening bell. We appreciate it.
The early bird catches the gains. This is Morning Brief Market Sunrise. Live from London, we deliver an early read on global markets, from overnight action in Asia to real-time sentiment across Europe's major trading desks and a live look at US futures. We cover the stories to help you, the individual investor, get the edge with actionable financial information and unbeatable context. So grab that coffee, tap in, and let's own the morning.